Hi, good morning, everyone. Thank you for joining. So welcome to this latest iteration of the masterclass hosted as a partnership between Old Mutual Insure and Asaba. So my name's Mohammed Kalia. I'm an actuary at PwC and also the president at Asaba, and I'll be the MC for this particular session. Just more background about these masterclasses. I think many of you would have attended these in the past. We've had some really cool topics previously. But basically, this initiative is to try and increase short-term insurance content within the industry, encourage knowledge sharing, and it's generally a deep dive by a particular expert. And it provides an opportunity for us all to learn, ask questions, and keep it as interactive where possible. So we hope we're all going to learn a lot. We have I think, one of the most well-known people in industry, in the short-term industry, as our presenter today. So I think also with April SAM returns on our doorstep, I think this is a very topical topic right now. So we're all keen to hear from Ron. The topic for today is SAM, the good, the bad, and the ugly. There's no pretty mentioned in the topic, but we hope there might be some. So just to introduce our speaker, I think everyone does know Ron, but Ron Richman is the Chief Actuary at Old Mutual Insure. He is a Fellow of the Institute and Faculty of Actuaries, or the IFOA, and of the Actuarial Society of South Africa, ASA. He holds practicing certificates in both short-term insurance and life insurance from ASA, Masters of Philosophy in Actuarial Science with distinction from UCT. Ron also chairs the Actuarial Society of South Africa's ERM and Climate Change Committee and is a member of the Aston board. So without further ado, I'd like to hand over to Ron to take us through his presentation. We do want to encourage as much as possible questions, which you can pop in the chat, and we'll facilitate that with Ron. So Ron, over to you.
Mohammed, thank you for the warm welcome, and it's a real pleasure being able to present at another Asaba and OMR masterclass. And the topic today is something that I've found fascinating. I'll tell a short story that on my first day of working as an actuary, my boss gave me the quiz 3 technical specifications to read through and said, okay, in about 3 hours, we're going to start. And that was a very scary first 3 hours of working as an actuary. And I've been thinking about SAM pretty much ever since, because this has been an ongoing journey. So hopefully the content today will just reflect a little bit of my thinking on this, and I guess the SAM journey that we all have been on, and I suppose that a lot of us still are on. So today's topic is SAM, the good, the bad, the ugly. What is this all about? So there's a very famous movie about the good, the bad, the ugly, and what does it mean in this context? So Mohammed, you've pointed out there's no pretty. I suppose the pretty might be the good, and that's what works well in SAM. The bad is, what are the things that I think we can go so far as to say are actually not currently working, and there are a few, in my opinion. And then the ugly, what's difficult and hard to deal with in SAM, and what are some of the thorny questions that come up? And you'll see we've color-coded this in green, red, and yellow, and we'll use that color coding throughout. Whenever we're going to have an issue that comes up in the slides, you'll see from the color which of the good, bad, and ugly we think it is. Yeah, please ask questions. Please just raise your hand, and then we'll come to you. And I see you've already got a hand up. Loretta, would you like to ask something?
That was a mistake. Sorry, Ron.
No stress. And yeah, let's get underway. So just the agenda. I hope that there'll be something in this masterclass for everybody. So we're going to start off slow. What is SAM all about? We're going to talk about how do you go from the economic balance sheet, which is what you really derive in SAM, to the SCR, which is your solvency capital requirement. We're then going to look at 2 examples, and those examples are going to be on interest rate risk and reserve risk, and there'll be some code we'll make available on GitHub that you can run and reproduce the examples. We'll then look at a deeper dive into a couple of issues and then discuss the conclusion and way forward. So what is SAM? SAM is Solvency Assessment and Management, and this is the South African version of Solvency II that we came up with here in South Africa to replace the old regulatory regime. So back in the day, you had a different regulatory regime for life insurance and a different regulatory regime for short-term insurance. And SAM is the current regime, which basically encompasses both. What's really nice about it is that there is Solvency II in a bunch of other countries. It's the regulatory standard in the EU. It's the regulatory standard in Mexico, Japan, Brazil, and maybe even one or two other places like Bermuda. So there's a lot of people doing this, and that means that our regulatory regime and the way that we understand insurance in this country is quite similar to what happens overseas. So you can always look at some of the overseas ways of dealing with things to get some information. SAM is a risk-based framework for insurers, which means the amount of capital that you need to hold, and really even theoretically the amount of regulatory supervision is based on the risks. And we'll be talking a lot about what that means and how you can quantify that. There's three main pillars of SAM. There's valuation and capital. There is risk management, which is pillar 2, and public reporting, which is pillar 3. And immediately one of the bads that we have in South Africa is we haven't actually implemented public reporting. So back in the days of the FSB with the old regulatory regime, you could call up the FSB, pay them 250 Rand, and they would give you a regulatory return for whatever company you wanted to find out about. These days, there's almost no public information about insurers except for those insurers that have a published set of accounts. This was implemented in 2018 after there was a lot of industry discussion on how to adapt solvency to the South African environment. And if you want to find out about SAM, your starting point might be the Insurance Act, but a lot of the regulation is actually contained in 2 sets of documents, the FSI's Financial Soundness for Insurer Standards, and then the GOI's, the Governance of Insurers. I say insurance there, you can get them at this link. And basically everything that you need to do in SAM is described in the set of documents. So if you're going to be an actuary working in SAM, and if you'd like to be a HAF or you've got a practicing certificate, you basically should know these documents almost, I suppose, off by heart. Is a little piece of personal advice, I guess I'd give. And one last thing to know about SAM, ASA has got a working group under the leadership of David Kirk called the SAM Phase 2 Working Party, and the whole idea here is to update key elements of SAM. So what's good about SAM? So this is the good. Introducing SAM into the South African industry really increased financial discipline. All of a sudden, you had a lot more complexity, a lot more rules to navigate, and through the process of getting up to compliance with SAM, that's increased, in my view, the financial discipline in the insurance industry. Another really good thing is it's risk-based, and we'll explore the consequences of that statement in a little bit, particularly through the lens of stochastic modeling. What's really great about SAM is you've got a standard formula reference point. So for almost any risk that an insurance company can run, you can open up the FSIs and you can say, okay, that's how it's modeled in SAM. And that gives you a starting point for any modeling you might want to do. And it also formalized governance in a really good way. The board has got clear responsibilities as to the control functions, and having a clear line of sight about who's responsible for what is always a good thing, at least in my opinion. And I'm saying in my opinion a lot. So this is a masterclass. What we're trying to do in a masterclass is provide the speaker's view from their experience and their understanding of the topic. And that's what I'm going to try to do in this session. So please don't take everything I say as set in stone and as fixed. People could disagree with me, and that's fine. And if anybody's got any commentary as we go along, you're more than welcome to raise your hand and we can have that discussion. So let's go through SAM in a nutshell. And you'll see that what we do, we've got a process where we're walking from valuation and capital to risk analysis and reporting. And this corresponds to pillar 1, 2, and 3 in SAM. So the first thing that you do in SAM is you do a valuation. And this is you produce what's called a SAM economic balance sheet. So in the SAM economic balance sheet, you try to quantify the value of your assets and liabilities. The way that you do this is you value basically everything according to the IFRS financial reporting standards, which is the basic accounting standards in South Africa. Then what you do is you revalue your insurance liabilities using a SAM market consistent valuation. And what that basically means is you do actuarial projections, you come up with best estimate numbers, and you discount on a risk-free curve. And then what you have is you've got your assets, which have been valued with IFRS, you've got your liabilities, the insurance component valued under SAM, and the rest of your liabilities valued under IFRS, and subtracting assets from liabilities gives you the most important number, which is own funds. And this is the amount of free assets which are available to support anything going wrong in your company, or to support other things that you might decide you want to do, like write new business, or do some go buy a company, or do whatever else you'd like to do, maybe pay a dividend off to shareholders. On top of that, and the second part of pillar 1 is you need to quantify what can go wrong on the SAM economic balance sheet. So you've got prescribed stress tests across most risk categories, and the key ones are market risk, insurance risk, operational risk, etc. And the FSIs tell you what are the stress tests you need to run. You then allow for dependencies between these risks and also the tax implications if these risks were to materialize. And you get out of that process your solvency capital requirement. And this is the amount of free assets you need to hold, or the amount of own funds you have to hold in order to support the company according to Solvency II or SAM, and that's the SCR. So something that you'll often see people do is take your own funds, divide it by your SCR, and as long as that ratio is bigger than 1, the Prudential Authority is not going to get too involved in your life. If it's under 1, then the Prudential Authority will start getting very uncomfortable. If it drops under another capital requirement, which I haven't really dealt with in much detail here, called the minimum capital requirement, they may even tell you to stop writing business, but hopefully none of us will ever get there. The next part of SAM is you need to do your own risk analysis. So this is pillar 2. And really the question we try to answer here is, what if the prescribed stress tests are wrong? That's one of the main questions. So let's say you get it wrong, and what happens in reality is much worse than what happens in your stress test, and you've got a big problem. And understanding if there is that problem is the first part of the ORSA. The other part of the ORSA, or the risk analysis, what will the future bring? So in other words, the company might be fine now, but is it going to be fine tomorrow, in 6 months, and in a year or 3 years' time? And that's the question you also try to answer. You do all of your own analysis and bring it into an ORSA, an own risk and solvency assessment. You then report this off to the board and the regulator, and this answers, is the company currently in a good and sound financial position? And the third pillar, like we've said, is you actually then need to tell the market about your key elements of your economic balance sheet, your own funds, your solvency capital requirements, and your ORSA. And I hope very much that one day in South Africa we'll start doing that, and we'll be able to have much more visibility about our insurance industry. So let's just do a quick visualization. I must thank Tyrell in the OMI team for putting together some of this material. Basically, what you do, walking from left to right, is you convert your IFRS assets to your SAM assets. You then quantify your technical provisions, which is in blue, your risk margin and your best estimate of your technical provisions. You might have other liabilities which are very similar to IFRS, and subtracting your SAM assets from your SAM liabilities gives you what is your basic own funds, or I've just called it own funds. And against that, you measure the final block, which is your solvency capital requirement. And if your capital requirement is less than your own funds, you get a thumbs up from the regulator and you carry on writing business. Let's think through the solvency capital requirement in a little bit of detail. So you see at the top of the house, we've got something called the solvency capital requirement, and that's made up of various subcomponents or modules, as it's called in the FSRs. The first one is your basic SCR. Then you've got your operational risk, your participation risk, and tax adjustments. And your BSCR is broken up into market risk, non-life underwriting risk, and for our colleagues who work in the life industry, you've also got life underwriting risk. And there's a very important thing called the correlation matrix. This is how you allow for diversification between your risks. So as we said a little bit earlier, you calculate all of these risk modules. You then allow for what is a diversified perspective, because you wouldn't expect all your risk events to happen at the same time. And that's already part of the ugly, which we'll get to a bit later. And you keep on aggregating until you get to your final SCR number. Let's talk a little bit about how you value your insurance liabilities under SAM, because as we said before, this is actually probably the key part of this first pillar of valuation, which is revalue your insurance liabilities using a SAM market consistent valuation. So the first thing you need to do is get your best estimate, which is the probability weighted future cash flows. So what you effectively need to do is And perhaps let's just go to the bottom part of the slide. What the FSI says you need to do to define your best estimate is you need to calculate the probability weighted average of an insurer's future cash flows stemming from its insurance business, taking into account A, the time value of money, which means you need to discount, and all possible scenarios of future potential outcomes. So being a mere actuary, like most of us on this call are, it's very difficult to work through all possible scenarios of all future potential outcomes, right? You could be sitting there running Monte Carlo simulation for the rest of your life. And this is why I've colored this in yellow or in amber, because this is one of the uglies. It's very difficult to actually do what the FSIs tell you to do. And interestingly enough, if you read the footnote from FSI 2.2, it says, although in principle all possible scenarios should be considered, it may not be possible to explicitly incorporate all possible scenarios in the valuation. So it's kind of walking this back a bit. Consequently, an insurer may adopt a method that implicitly allows for all possible scenarios, like the use of closed form solutions in life insurance or the chain ladder technique in non-life insurance. And there's two main issues over here. I suppose the first issue why this is one of the uglies is no one can do this, right? So it's very difficult, honestly, to believe that you can evaluate all future scenarios and you've got perfect knowledge of the future. But even worse, the FSI itself is self-contradictory. It's telling you you need to do X, but then in fact it's saying, well, you can't do X and you can use an approximation. So what do you actually need to do? The other funny thing over here is anyone who's ever done short-term or non-life reserving knows that the chain ladder technique actually doesn't cover all future scenarios. And I don't know if anyone on the calls maybe got a view of what the Prudential Authority might mean here, but generally the way you calculate your chain ladder is you average over recent past experience to get an idea of your development pattern, apply that through, and that's basically your best estimate assumptions. Definitely doesn't implicitly allow for all possible scenarios. So that's the first ugly, or the first big one that we've come across. Then what you do after you have your best estimate cash flows, you discount. You only do this up to the contract boundary. In other words, you don't take into account premiums that the policyholder contractually doesn't owe you. That's just a simplified way of saying it. This includes all future expected expenses. In the short term, we'll do lay E and A, lay E on claims reserves, and you do this gross of reinsurance and then cede it. So I spent a long time thinking about this for a bit, and together with Caesar Bologna, I don't know if Caesar's on the call, he's not, we wrote a paper in 2020, and we said we basically don't know the probability distribution of cash flows in the future. So rather than doing something that you can't do, why don't we select a valuation method that we expect will lead to minimal error? And how can we do this? And really, this paper that I wrote with Caesar in 2020 is an illustration of how you can do that. So the best estimate, just quoting from the paper, is, and this also appears in Solvency 2 and in IFRS 17, the best estimate should correspond to the probability weighted average of future cash flows. A more pragmatic definition of the best estimate could be that at your valuation period, your estimates of ultimate claims are expected to correspond to the actual claims that will be reported with minimal error, which you could quantify, for example, using the mean squared error. And we discussed exactly how to do this sort of best estimate valuation in the first masterclass we gave, which was on the Cape Cod reserving method a few months or years ago now. Okay, so now that's an alternative definition of the best estimate, and I think it's something that's much more pragmatic and actually closer to what we do as actuaries, because what we do when we set valuation assumptions is we're trying to look for a best estimate that's justifiable based on recent experience, and we hope that that best estimate is actually going to be good for the future. No one can do this probability weighted average of future cash flows. So now let's run through a couple of the risks that comprise the SCR. So I'm just going to, for each one of these, quote the definition. So market risk is the risk of loss arising from movements in market prices on the value of an insurer's assets or liabilities. And I'm going to leave out that next part of the sentence because that's another ugly. But exposure to market risk is measured by impact of movements in financial variables like stock prices, interest rates, real estate prices, and exchange rates. And out there in the big wide world of banking, asset management, insurance, market risk is one of the best modeled risks in the market because everyone's got exposure. So this means there's a good incentive to build good models that you can sell to everyone, and the data is easily available at almost any time granularity. One interesting thing, if you're going to do market risk modeling for SAM, is forget about what you learned in subject CT8, which was risk neutral valuation. That's good for options and other derivatives. You need to consult the much smaller group of papers and literature and actuarial thinking on real world market risk modeling, which is useful for risk management in Pillar 2 in SAM. Credit risk is a really interesting one. So credit risk is measured in the market risk module in SAM. So just going back to that piece of the definition I didn't read, it's the loss arising from the default of the insurer's counterparties. So why is this in market risk? This is actually different from the rest of Solvency 2. And in a way, downgrading credit risk and making it part of market risk means it gets a lot less visibility than perhaps it should. There's a number of different ways of modeling credit risk. In SAM, we try to model in particular default risk. This is the risk of non-payment in non-bond assets. You can model transition risk, which is the risk of a change in the credit rating of the company that you are interacting with. And transition risk actually isn't in SAM. And then you can model spread risk, which is the risk of a change in the market price of credit risk. That's only applied to bond assets. So this is bad in my view of the good, bad, and ugly, because there's some missing risks. A bond, you might not just have the risk of your market price of credit risk changing. You might also have an issue that your bond just defaults and you don't get any proceeds from that bond instrument. And it's very strange to me why that's left out of SAM. And it's definitely something that if you've got a big corporate bond portfolio, I guess you could consider in an ORSA. But then sovereign default risk. Sovereign default risk is the idea that you can't consider your yield curve to be risk-free, and the sovereign itself can default. And definitely as the years have gone by and South Africa's credit rating has dropped, more and more actuaries talk about sovereign default risk as being a risk that you need to consider in the ORSA in Pillar 2. A very interesting thing about default risk in SAM is that a lot of it's done through type 1. So type 1 is often used for reinsurance risk. So let's say your reinsurer owes you a very big claim of 100 million rand. There's that risk that they may actually decide or not be able to pay you, and that's default risk. This is a binary event, and it's often got very small probabilities. And anyone who's gone through FSR 4.1 and then FSR 4.3 with the impairments that you need to add, you'll know that there's this very interesting model in SAM with something called gamma, with something called, there's a number of other parameters. There's your basic implied default parameter. There's some sort of shock. And one of the uglies is in fact that the SAM default model is not particularly well known. This model comes from a paper called Portfolio Modeling of Counterparty Reinsurance Default Risk. And it's what's called a common shock model. So in other words, if you have a shock that reverberates throughout the market, everyone's probability of default increases. And what's very interesting is that, to my knowledge, this model is actually used nowhere else in finance, so it's quite hard to validate or understand I suppose, the idiosyncratic nature of this model, just because no one actually uses it. So that's a little bit on type 1 default. And then a very interesting thing about credit risk modeling is, if you're in the banking environment, what you'll often see people write out as an equation is this, that credit risk is what's your best estimate of credit risk is what's your exposure at default times by what's your probability of default multiplied through by, given that a defaults happen, what is your loss given default? And what we'll be quite familiar with in SAM is the probability of default and the loss given default parameters, which you have, as we said before, in the SAM type 1 default model. But then something very strange happens, which is to model exposure at default, FSR 4 requires you to use your non-life underwriting risk module. So there's a little bit of a quote on the side, which says that an adjustment for risk mitigating instruments must be calculated by deducting an impairment factor. And this impairment factor needs to be calculated, you'll see over here, using type 1 default. So what that basically says is you're going to do your non-life underwriting risk scenario. You're going to think your biggest building is caught on fire and you've now got a 3 billion rand claim. and you're going to then say, well, your total exposure to your reinsurer was 100 million rand before, is now 3.1 million, and recalculate this equation in a stressed setup. So what that basically means is you're using a 1 in 200 year scenario as your exposure at default. And this is, in my opinion, something that we could potentially do better, because we're likely stressing reinsurance recoverables at a much higher level than 1 in 200. You could perhaps think it's 1 in 200 squared. So that's an interesting thing on credit risk. Guys, please also feel free, as we said, to ask any questions as I'm going along. So yeah, if something sparks your interest. Insurance risk is defined in FSR 4.3, so we're focusing on non-life here. It's the risk arising from non-life insurance obligations, such as poor claims experience, expense overruns, and policy lapses. There's also a module for life insurance risk, which our colleagues in life insurance use. And there's really two main goals of non-life insurance risk modeling. You want to capture future risks, which is what could happen on risk that hasn't occurred yet. And this is often attritional or premium risk and catastrophes. And then you also want to capture your past risks that have already occurred. And this is all about reserve adequacy. So in the South African market, you've got industry models for earthquake risk, which is great. But you don't really have such good models for the other perils. And what's quite fascinating about SAM, and this is one of the uglies, is we're missing out on flood risk. And if you think about it, we'll discuss a bit later, flood has been responsible for the biggest insurance loss in the South African market that I'm aware of, and also cyclone risk for the east coast of South Africa. Okay, so that's a very natural time to stop. We've discussed a little bit about the economic balance sheet. We've discussed a bit about the SCR. Let's just see if anyone's got any questions or comments. Okay, so let's carry on then. Let's just see in the chat. Okay, nothing yet. So let's now go from the economic balance sheet to the SCR. So how can we understand the SCR a little bit better? So the FSR 4 definition says the SCR is calibrated to correspond to the value at risk of the basic own funds of an insurer at a confidence level of 99.5% over a 1-year time period, right? So how do you understand? How can one understand this? What does this mean? So for many items on the SAM economic balance sheet, we've performed some sort of valuation. We've either done mark to market, or which is basically, let's say you own a share, you look that share's value up on the JSE, and that's what you put in your accounts, or you do mark to model. So you may have some very complex derivatives that you've got a backing risk neutral model to value them, and that's how you do your valuation. Or on the liability side, you'll have a traditional actuarial valuation plus a risk margin. And really the question that we're trying to answer in the SCR calc is, how could your valuation go wrong? It could be because your external environment changes, so a cargo ship crashes into a bridge, or you might have made an estimation error in the valuation. And the reason the or is in amber is because this is another one of the uglies. As we'll see later, this definition isn't particularly consistent in SAM. But something that's very good is that the key principle of the SCR is really build a stochastic or statistical model of how things can go wrong, and then you can read your SCR out of that. And the corollary of that is that the methods to derive the SAM Solvency II SCR numbers, in fact, give you an underlying stochastic model for insurers if you know where to look that you can rebuild. And we'll look at some examples of that coming up shortly. So what model actually underpins the solvency capital requirement in SAM or Solvency II? And where can we learn a little bit more about this good stochastic model that we have? There's some good primary sources. So sometimes when you read the FSRs, they make this explicit. For those of you who were around when SAM was getting put together, there's the SAM discussion documents and position papers, which were put together by the Actuary in association with the FSB and ASA, and this often describes what the rationale of the methodology was. You can look at how to calibrate insurer-specific parameters in FSR 4.3. And finally, if you want a bit of an international flavor, you can look at the CEOPS and EIOPA calibration documents. CEOPS was the predecessor to EIOPA, and EIOPA is the current European regulator. So let's have a quick look at one of these sources if you're trying to understand what the stochastic model is. So if you look at FSR 4.3, and in section 5.3, it's talking about premium and reserve risk, and it says the capital requirement for combined premium and reserve risk should be calculated as 3 times sigma times the volume measure. And you've got a helpful footnote which says this formula assumes a normal distribution of the underlying risk and rounds the resulting 99.5% value at risk calibration to 3. So this basically tells you that the correct way of doing, or the correct way of understanding the stochastic model that we have over here is a normal distribution fit around your risk. And we'll have a look at an example of that in just a little bit. So let's talk about a recipe to go from your economic balance sheet to your SCR. The first part of the recipe is identify which item you want to think about on your economic balance sheet. So let's say reserve risk, you'll look at your claims reserves. Your interest rate risk, you'll look at your interest rate sensitive assets like your bonds. What you'll then do is try to define what risks we're going to model. So for reserve risk in SAM, it's something called the claims development result, or the CDR. We'll define that in just a bit. For interest rate risk, it might be a change in the valuation of your assets. Then what you should do is fit a stochastic model and take the 99.5th percentile. And this recipe works, except for the uglies where it doesn't. And there are a couple which we'll just briefly mention. We mentioned operational risk just a little bit before. Operational risk roughly corresponds to an extra unanticipated expense that you didn't expect, or some other loss. So you generally can't find an item on your economic balance sheet for operational risk. And then this one is one of the baddies. What you have to do in SAM is also take into account the new business on your SCR. So I've just had a little bit of a quote from FSR 4 on the side over here. What this says is, Mohammed, I see you have a hand up. You want to go for it and then we'll come back.
Yes, it's actually a question in the chat box from Itumaling.
Yeah.
So the question is there a reason why the SCR is based on VAR and not tail VAR, despite the advantages of TVAR over VAR? Is the VAR the best way to be calibrating SCR?
I think what's really important to say is that there's only very few regulatory systems worldwide that have endorsed tail VAR or CVAR, which is effectively the same thing. A very interesting point to make is that for every value at risk number that you derive by playing around with your probability level of your expected shortfall or your TVAR, you can derive exactly that same value as your value at risk. So there is also a mathematical correspondence between the two. And there's a whole model of that called PELV from Raudo Wang, who's one of the top researchers in risk measures. So the basic bottom line is the only place that TVAR is used is in the Swiss solvency test, or maybe Basel, if I'm not mistaken. I don't know if anyone on the call's got any banking experience, but in insurance, it's the Swiss solvency test, and it just hasn't been endorsed by industry. So I hope that's a good enough answer. Okay, so let's just have a quick look at this, another one of the difficult parts in the SCR. So your SCR should cover the risk of existing business as well as new business expected to be written over the coming 12 months. And in the standard formula, new non-life insurance business is taken into account in the premium risk. And the way that you do that is you use a volume measure. In other words, you put in all your earned premium that you expect for the coming 12 months, regardless of whether this business is actually on your books yet or not. It's just your expectations. And this is one of the baddies, because a lot of the difficult questions you come across in interpretation of SAM from a non-life perspective is this mismatch between what you quantify on your balance sheet versus a different contract boundary for your SCR. So that's something you might encounter if you're ever thinking about how to deal with commission payments on complex reinsurance. Okay, so let's try apply this recipe in some examples. But just before we do that, let's see if there's any other questions.
I think we're all good for now, Ron.
Cool. Thanks, Mohammed. So let's look at some examples. So we're going to look at two examples. We're first going to look at reserve risk, and then we're going to look at interest rate risk. We'll walk through a script that I've written to quantify this for two toy examples, and we'll obviously make the script available on GitHub after the session is over, just obviously with the proviso that no liability is taken, or there's no warranty of fitness for purpose in using the scripts, but hopefully it will help to illustrate just a couple of these ideas that we're talking about. So let's start with reserve risk. And reserve risk is probably one of the most complex items that you have in SAM or Solvency II. And it's also an area that I don't think too many actuaries actually know too much about. So here we're using the colors in a slightly different way. Green refers to this green in the triangle, and then yellow or amber refers to the next diagonal. So generally what we do is there's two different ways of looking at reserve risk for short-term insurance. And what we mean by that is if you look at your IBNR and your OCR, there's two different perspectives that you can take on quantifying the risk. There's the ultimate view, which is you're interested in not only what happens next year, which is the yellow diagonal, you're also interested in the full future runoff of your liabilities. And there's famous ways of quantifying that, which you might be familiar with from IFRS 17. You could take a 75th margin, and the way of doing that is you might take the max standard error of reserves, or you might decide to bootstrap. And maybe let's just see by a show of hands who actually has done some of this reserve risk stuff in their career. I don't know if anyone who's listening would like to put their hand up if you've done it. Awesome. So at least 4 people have done it. There we go. Then there's a much more complex view called the 1-year view. And if you remember what we said is that the SCR needs to be calculated over a 1-year time period. So what does that mean from a reserving perspective? So you raised reserves on your balance sheet. And what you're now interested in is what's the worst thing that can go wrong over the course of the next year. So this is going to be what can go wrong in the size of your claim payments on this diagonal in yellow, plus how much could your IBNR reserve change in respect of the blue portion from the beginning of the year to the end of the year. And this is the definition of the SAM reserve risk. The easiest way of quantifying this is with the Merz-Wuttrich formula, or there's another method using bootstrapping called the Actuary in the box. So let's maybe see just by show of hands who's ever done 1-year reserve risk calcs for reserve risk. So we had 25% of, okay, 2. Great stuff, guys. So let's do a quick intro on how you can do this. So what is the reserve risk model in SAM? So if you remember our recipe, we've identified the item on your economic balance sheet. We want to sort out claims reserves. We're now going to use a stochastic model of the claims development results. And this thing that we've been describing, this 1-year risk, the technical terminology for it is known as the claims development results. So there's a famous closed form model for the 1-year reserve risk in SAM, which is the Merz-Wuttrich formula. It's a very famous paper from Michael Merz and Mario Wuttrich. And on the assumption of using a chain ladder distribution, and from an ultimate perspective, a lot of you might know that the variability of your ultimate claims is given by max formula. What Merz-Wuttrich does is it adapts this formula for the 1-year view so that you meet your SAM definition. Why is this in amber? Why is this one of the uglies? Because we often don't use the chain ladder formula for our reserves. We often use Bornetta, Ferguson, and Cape Cod. And 2 years ago, we presented a paper on how you can do a lot of this 1-year reserve risk stuff using the Cape Cod method, and this was presented at ASA. So how do we know we can use Merz-Wuttrich? If you look at FSI 4.3 attachment 7, some of the insurer-specific methods that are given for quantifying reserve risk, that actually tells you you can use Merz-Wuttrich to do this. And we can easily derive some results using R and the chain ladder package. And let's quickly step through that in R. So let's open that up. And here is a very simple example of Merz-Wuttrich. So this is going to use the chain ladder package in R. And this is a very nice reserving package if you use R. There's also a chain ladder package in Python that's becoming quite popular as well. I don't think it has Merz-Wuttrich. So the first thing that we mentioned is you want to calculate your IBNR using the chain ladder. So there's this command called mac chain ladder, which calculates your IBNR and also very nicely gives you the MAC estimate of the standard error. So in this particular case, let's look at our triangle. This is a very famous triangle that was used in Mac's original paper, and you often see this used in RBNR applications. So we want to know how much RBNR do we need, and the answer for that is we need 18.7 million rand of RBNR. And that RBNR has got a standard error, or you can think of that as a standard deviation of 2.4 million rand. So just a very simple calculation. If you think about what we saw in SAM, if you multiply this by 3, that would give you a little bit of a heuristic on how much capital you'll need for this particular line of business in SAM. There's a very interesting quantity called the coefficient of variation, which you often have in a reserve risk. That's nothing more than the standard error divided by your best estimate. So you can see there's a standard error of 0.13. And let's just get rid of our commas. And there you go, you can see it's 13%. Often what actuaries used to do back in the day in short-term reserving is you'd fit a log normal distribution to your estimate of the mean and your estimate of your standard error. So here's a very quick formula to do this with the method of moments. And here you can see a full distribution of your RBNR, where your mean is about 18 million rand, and you've got these tails all the way. You've even got something up to 35 million rand, which means your estimate could be off by about 100%. So what does this all mean? This is on an ultimate view, like we've been saying. Now let's derive the 1-year view, and this is extremely easy. You take your MAC chain ladder command and you pass it through the claims development result. And what this gives you is a, sorry, let's just run this one. This gives you your 1-year view of risk, and you can see here it's 1.7 million compared to 2.4 million, and that number is a little bit lower on a 1-year view than it is on an ultimate view. And then what you can do is you could also simulate from this. So I'm going to do that. I'm not going to dwell too much on what exactly it means, but I'm also going to use, instead of a log normal assumption, a normal assumption. And let's just have a very quick look at what these outputs look like. And we can actually go back to our presentation for this. And here's what you get, right? So here's a histogram on the left part of the slide. This is the full distribution of your reserves under an ultimate view, which is in red. You can see it's got quite a nice long tail. And in blue, which is much more constrained because it's only what's the worst thing that can go wrong over the course of the next year, which is in blue, your claims development result. And you get a very similar looking plot if you use a normal distribution assumption, which is the stochastic model underlying SAM, and you get the image on the right. So what should we take away from this? What we've just basically done could be an ISP calc, if you're interested in doing insurer-specific parameters for SAM, but it just also re-emphasizes the fact that SAM isn't just a bunch of formulas in some PDFs you download from the Prudential Authority website. There's a lot of thinking that's gone into this, and B, there's actually a full stochastic model that you can derive. And starting to think a little bit more about those stochastic models is something that I think would be very good as how we do SAM in the actuarial profession in South Africa starts to mature. Okay, I see there's something in the chat. Is there a question here? Okay, any questions on reserve risk, guys? Come on, maybe the OMI team who's seen some of this before can ask some hard questions. James, go for it.
Sorry, I was going to type, but I thought that would take too long. In terms of the stochastic models, how much purview does each insurer have to build their own and apply it versus needing sign-off on each?
Brilliant question. The answer is you've actually got no purview whatsoever until you get permission from the Prudential Authority. And there's two ways of doing that. You either can apply to use insurer-specific parameters, and this is a little excerpt from attachment 7 in FSR 4.3, which tells you a little bit about that, or you can apply to build a full internal model. And currently in South Africa, there's only one company that we're aware of that has got Prudential Authority permission to use an internal model. But it's something that I think would also be very good if the barriers to entry to doing that were reduced, because it costs a lot of money and it's very difficult to actually get over the line. So I hope that kind of answers the question, James.
Yeah, and then do we use these to calculate ISPs, or do we stick to standard formula?
So Old Mutual Insure, I'm assuming you're saying by we.
Yes, definitely.
Yeah, so at OMR, we still on standard formula. Maybe if
Perfect.
there's anyone in the audience from another company who might want to comment if you've seen any internal model work, but yeah, currently there's only one company I'm aware of that has got a full internal model. Okay, so that's one example. Let's look at another one. This is also relevant for our colleagues in life. So interest rate risk out there in the big wide world wide of SAM is often modeled using principal component analysis. And if you look at position paper 94, which is one of the old discussion documents or positioning papers that was written by ASA and the FSB when SAM was being implemented, this is what they actually did. They used principal component analysis, and they have a little bit of a description over here. So the stochastic model is basically using principal component analysis. The way this works is it isolates the risk factors which are responsible for most of the variation observed in a data set. You then fit this principal component analysis in your monthly changes in the yield curve, and then scale it back up to get a 1-year stress. And then on the assumption of using a normal distribution, you can simulate from the main drivers of variability of the yield curve and derive your 1 in 200. So let's do a very quick example that I will illustrate this with using EOPA data. So EOPA does this very helpful thing of providing yield curves for a lot of different markets. And here's a little view on the right-hand side of the screen of what does the South African curve according to EOPA look like since 2015 to 2021. You can see it's particularly moved at the short term. And what you'll have observed if you're familiar with the yield curve movements is this has gone up quite dramatically across all parts of the yield curve in recent years. So now what we're going to do, very quickly, we're just going to derive your density of the log of the returns of the yield curve at different maturities. And you can see this is all centered at around 0, which is similar to your efficient market hypothesis. Your best guess of what's going to happen tomorrow is what you know today, but you can also get quite extreme changes, and there's even at some maturities all the way out to a 20% change. So how do you do principal component analysis? In R, it's a one-liner, and it's that line over there. And let's have a look at some of the information you get out of principal component analysis. The first thing that you do is we've now got 19 risk factors, and these are ordered by how much of the variance is explained by each one of these risk factors. And maybe what we'll do is let's look at the actual risk factors themselves, because that will be a little bit easier. So I've only picked the first 4. What you'll see over here is the value of 0, right? And the first risk factor is this red line. And you'll see that the shape of the red line looks suspiciously like a yield curve. And what that basically, the interpretation of it is, it's a shift in the same direction of all parts of your yield curve. So you can see it's above 0, it doesn't cross 0, so everything gets the same change, because we're modeling the change in yields over time. And you can see that's different, for example, from the second risk factor, which is more about the twist of your yield curve, because what this means is, because it crosses 0, some parts of your yield curve will decrease and some parts of your yield curve will increase. So I'm not going to go into too much detail on how to interpret PCA, but let's actually just do some simulations and derive a full distribution exactly like it's done in SAM. So it's a little bit of code, takes a little bit of a while to run, and here we go. So this is what the data tells you about your log returns and how they distributed. And then these much neater distributions come out of the PCA, and basically what you'll do is you'll grab the 99.5th out of these, apply that to your current yield curve, following the same recipe that we had for deriving your SCR, and that will give you a very good idea of what your 1 in 200 should be. And here's just a plot, which I won't go into in too much detail, verifying that this is actually working. Okay, so let's head back to our presentation, and I'll make just 1 or 2 other interesting points on interest rate risk. I can find our place, which is a few years ago, when I was at QED, we decided to recalibrate the 1 in 200, because what was originally done from SAM is this used JSE yield curves up to 2012. But then the Prudential Authority started issuing their own yield curves. So the actual SAM stresses are shown in the dashed and dotted line. And this is at different terms to maturity. And then the recalibrated one that we derived back in the day is the solid line. And you can see particularly at your kind of short end of the curve, it's extremely different from the PA curve. And that's due to different ways of deriving that curve. So this is one of the bad things in SAM, which is a lot of SAM is now a little bit out of date, because a lot of this was derived on data up to 2012 or 2013. And anyone who's looked through the last 11 years will know that things have changed just a little bit in the world. And that's why relying on what happens in, or relying on a much older calibration is something that can be a little bit risky, at least in my view. But that's what you have to do from the PA's perspective. Let's quickly stop there and see if there's any questions on the examples. Okay, so I think we're good to go. Let's have a look at some of the deeper dives into just this theme of the good, the bad, and the ugly in SAM. So a really interesting point that I haven't really seen emphasized by too many people is if we go all the way back here, your first step in SAM is revalue your liabilities. And this is very much in terms of a best estimate. But what this implicitly assumes is that you're going to be able to calculate your best estimate correctly. In other words, that your best estimate is an unbiased estimate that's actually fit for purpose. And this is one of the uglies. So what happens if this is violated? And this is an example from a paper I wrote with Andrea Gabrielli and Mario Wuttrich in 2020 about using neural networks for IBNR reserving. And what we try to see is what happens if your chain ladder method produces a best estimate that's actually biased. So a very big issue when you use the chain ladder method is looking for trends. Over here, you can see the actual trends fit by the neural network. But if for those of you who are familiar with applying the chain ladder, you'll know you often only fit one of these curves and hope that it's fit for purpose across all of your accident years. And the big problem over here is that you find your SCR can be dwarfed by the bias. So what does that mean? Have a look at this table on the bottom right-hand part of the slide. The true reserves that were required were 37 million rand. The best estimate chain ladder method only gave you reserves of almost 36 million rand. So it was about R1 million off, right? If you then look at your mean square error, which is your standard deviation, you see that your bias is almost equal to your standard deviation. Let's look at another example for line of business 3. Here, your true reserves of 16.8, your chain ladder was 15.8, another R1 million of bias. And here, your mean square error of prediction is only 500. So that means that your bias, in other words, the fact that you got your best estimate wrong, is almost double your standard deviation. So what SAM envisions is you're going to get your best estimate valuation correct, and then you're going to add capital on top of that. But you have a very difficult problem is what happens if you actually get your best estimate wrong. That can completely and utterly invalidate your capital estimates. And this is the responsibility of us as actuaries to ensure that you're actually raising a real best estimate and you're getting it right. And this is also true in the life world. Let's say you choose a mortality table and a set of lapse assumptions and all of those sorts of good things, but you forgot to update your lapse assumption. It could very well be that the error in the reserves is double as big as your SCR. And that's something that as an actuary, you probably don't want to be responsible for in a SAM world. Another very interesting thing is, like we've seen, the way that you derive your SCR is you take observed data, you fit some nice statistical distributions to that, and then you look at the 99.5th quantile of the distribution to derive your stress. But what happens if your underlying processes have broken down so much that your statistical distribution is no longer applicable? So let's think of some examples. And the very sad example we've got to look at is Sasria and the KZN riots, but also COVID-19 business interruption claims, which almost the whole South African market suffered tremendous losses on. And in those cases, this was such radically different experience from what had happened previously is that these were way beyond the 1 in 200 year mark that you ever would have been able to derive. So what we have to remember, and this is one of the biggest uglies in SAM that I'm aware of, is that the 1 in 200 is in the world of the model, not in the real world. And this leads to a potential disconnect between SAM capital and actual capital needs in extreme events. So one interesting question to ask is, have we oversold SAM? And another one is, do our key stakeholders actually understand that when we're talking about capital and 1 in 200 year events and all of these things, that we're actually talking in the model world, not in the real world? So this is SASRIA. So this is the sorry story of on the first day of the KZN rights, the state-owned insurer says it has 3 times the capital required by regulators to meet unrest-related claims. 3 days later, they said it's too soon to quantify this. And the rest of the story is, if I recall correctly, that the capital shortfall in SASRIA was bigger than the assets on the balance sheet, never mind the own funds. So another very good reason why you've got to be very careful about telling management, which is what we do as actuaries, about the 1 in 200. Another interesting one, this is from a presentation we often use in Old Mutual, that the cat is out of the SAM bag. So we had 32 billion rand of claims in SASRIA. We had 36 billion rand of claims in KZN. And this is far beyond anything that you have in the SAM model. I suppose another problem is you don't even have flood risk in the SAM model. So we need to be humble, I suppose, about what we think we're doing when we're calculating a 1 in 200 year event. So this is a really nice book from Richard McIlrath called Statistical Rethinking, and he's got some really good ideas. I just want to quote and read a little bit here about small worlds and large worlds. So small and large worlds provide a contrast between the model and reality. The small world is the self-contained logical world of the model, and the large world is the broader context in which one deploys a model. And in the large world, you can even have events that weren't imagined in the small world. And all statistical modeling has these two paradigms or frames, the small world of the model and the large world we want to deploy the model in. And navigating between these worlds is a central challenge of statistical modeling. And I think it's also a central challenge of the work we do in SAM, that we're very focused on this 1 in 200 year number, but I don't think we've adequately communicated what that means. And maybe a question you can ask is, can we use stress and scenario testing to correct this? Because this is where you imagine things that can go wrong. And if you do that right, maybe you can sort it out. So let's talk a little bit about stress testing and scenario analysis. So often when you don't have good models or you don't fully trust your model, you do stress or scenario testing. The way I understand the distinction, maybe I've forgotten my ST9 notes, but the way I think of this is stress testing is a univariate stress on one risk factor with no narrative, and scenario analysis is a multivariate stress that's backed by a narrative. And this can uncover really important insights. But as actuaries, this is one of the uglies, because you usually can't make any sort of probabilistic statement about the scenarios. So you spend all this time telling management about the 1 in 200, and now we're going to talk about scenarios where you can't even say if it's a 1 in 10 or 1 in 100. That's a very big problem. This next one also should be an ugly. It's hard to be creative enough. So now that we think about what happened during COVID, we know all the impacts on insurance, but how do you do that looking forward and not backwards? And one of my favorite answers to at least the probabilistic component of this is this book from Ricardo Rebonato. And he's a brilliant quantitative quant, I should say, and he's got a way of actually creating scenarios that come with probabilities. So that's very nice. Let's talk about something a little bit different, but still on the scenario theme. So for those of you who've done non-life underwriting in SAM, you'll know that scenario analysis is actually explicitly built into SAM. So for example, in CAT method 1, in man-made CAT, and this is FSR 4.3 attachment 9, it says for marine risk that one of the things you have to do is think about a scenario of a collision between 2 container carriers. And this is supposedly going to give you your 1 in 200. It's just interesting when you think about the current context of the ship that crashed into the bridge in America just a few days ago, where that's probably the biggest loss from a marine policy in the history of insurance. But what's difficult over here is, here's where you have one of the baddies. Here SAM departs from an underlying stochastic model, and it's impossible to verify if this is indeed a 1 in 200. Another issue on the theme of Method 1 CAT, I call the slide, what do you rate? So a fundamental metric in non-life insurance is rate, which you can define as premium over sum insured. So this is basically what does it cost to insure R1 of your sum insured. And for some reason, our colleagues in America in P&C insurance love talking about rate, but South African actuaries almost never talk about rate. But something really important from a SAM perspective is that, let's say you've got two different rate levels. Let's say you've raised prices by 14%. So on rate level A, you'd calculate a loss ratio of 80. On rate level B, you'd calculate a loss ratio of 70. And one of the biggest uglies in SAM is that SAM actually ignores rate altogether. So if you think about method 2 CAT, where you multiply loss ratios by premium, you don't know what the rate level was when those stresses were derived, right? So it's very hard to know if you're actually applying this as it should have been applied back when SAM was put together. And this is also something that will affect premium risk. I think about 10 days ago, ASA held a sessional with an American actuary who spoke a lot about rate. I don't know if anyone attended that, but it's definitely an issue that we don't think about enough in SAM. Let's talk a little bit about how the standard formula was calibrated. So like we said, a SAM relies on calibration performed in 2015 and prior with some statistics and a lot of expert judgment. Some of the work I've done over the years has been, for example, showing, this is now a live example, that the SAM shocks don't tie up with what you get when you look at big mortality data sets in South Africa. And now this is maybe the biggest ugly in the whole presentation. So as we said, the way that you calculate your SCR in SAM is you have many detailed calculations for each module. So you're going to do, in non-life underwriting risk, you'll look at premium risk and reserve risk, and you'll do a lot of aggregation in premium and reserve risk. You'll then aggregate between CAT risk and lapse risk and premium risk. And the end of this is you've done a lot of very accurate calculations, which often can reduce your SCR by, say, 30 or 40% than if you didn't allow for it. And this excerpt is from FSR 4.1, which basically says you should use correlation matrices and you should allow for diversification benefits. In the footnote, it says the setting of correlation coefficients for aggregating capital requirements under the standard formula is intended to reflect potential dependencies in the tail of the distributions, as well as the stability of any correlation assumptions under stress conditions. Now, what's very interesting is, why do we not include a diversification SCR? And what would that mean? So we've got some risks. What happens if your correlation assumption breaks down in a certain scenario? So you don't get the expected diversification. You may have misestimated the correlation coefficient, and you could just have plain and simple volatility around your best estimate. So the one good thing over here is that if you do have an internal capital model, you'll mitigate some of these. But this is maybe the most puzzling thing for me in terms of a paradox in SAM. We always stress all of our best estimates, but we don't stress our best estimate diversification. And that's not just a shortcoming in SAM, that's a shortcoming in all Solvency II style regimes. Okay, so we're almost at the end of the presentation. Let's quickly talk about ORSA. So ORSA is your main Pillar 2 process, and the idea is to make sure the insurer is adequately capitalized. You've got your requirements in GOI 3.1. And maybe a question for the audience, and let's see this by a show of hands. If companies are only using the same standard formula, can you actually fulfill the ORSA requirements? Because what you need to do is, where an insurer employs an economic capital model, you have to justify why you don't use the standard formula, and vice versa. Where you use the standard formula, you need to justify why you think the standard formula is accurate. And how you're going to do that if you don't actually have a separate point or separate model against which you can compare. So let's see by show of hands, guys, who thinks you can do the ORSA requirements if you only have a standard formula model? Maybe I should have said it the other way. Who thinks you can't do the ORSA requirements if you only have the standard formula model? Okay. So I've convinced 6 people, I guess. So maybe we've done one good thing in this masterclass is that now 7 people believe you should build some more models. Okay, I think that's a good thing. And this is why you should build an internal model. So I must thank Stuart Green for this very nice picture. And what this is just a graph of what you get out of your internal model. This is profit and loss. Let's say that's 0. So this is where you make profit. This is where you make losses. And your internal model gives you a full distribution that you can break down by cause and say, what is our view on exactly what your 1 in 200-year risk is? And this allows you to exactly answer the question required by the ORSA. It's also a very useful thing to have for reinsurance optimization, risk appetite, and all of those sorts of things. So something I'd encourage everyone to do is along the way, do yourself a favor and learn a little bit about capital modeling, because it's really interesting and it's actually really useful. So in SAM, did we forget something? So Pillar 3 has got extensive market reporting requirements that where you make significant parts of Pillar 1 and 2 publicly available. And it also has got something called an SFCR, which is like a public ORSA. Sadly, in South Africa, we haven't finalized these requirements, but if you follow the link, you can see AIG UK Limited's SFCR. You'll just see the quality of information that our European and British colleagues have at their fingertips. And maybe I'll just talk through a few other quick issues that I think are relevant. So we said standard formula versus internal model. Almost all of our insurers use standard formula in South Africa, which is quite sad. And it's partly due to a lack of skills in our market, but also due to maybe a too onerous model approval process. And again, that's just my personal opinion. Another interesting thing, like we said, is what are we trying to estimate, right? So we saw in reserve risk, you're trying to estimate what could go wrong in your IBNR estimate. And you're also looking at your volatility risk. But reserve risk is one of the few places in SAM where you actually care about parameter error. When you're looking at interest rate risk, you don't care about parameter error at all. So that's an interesting question. Why is there a fundamental misalignment of SCR shocks? Do we care about parameter error? Do we care about volatility risk? Do we care about real world scenarios, and what determines which one of these apply? And one really good place to think about parameter error where it's not considered in SAM is in your type 1 default, where you take your probabilities of default and loss given default parameters as given. And in fact, these are highly uncertain quantities. And then a last one for our non-life, maybe a biggest issue in our non-life world, is the issue of volume. So it's very well known that smaller companies have more volatile experience. And this is particularly the case when you estimate reserve risk. And this is a reason why actually the SAM parameters aren't fit for purpose for any company, because they're an average across the industry and aren't meant to be correct for any particular entity. This is why you shouldn't use your SAM parameters for IFRS 17 risk adjustment. And here's just a little excerpt out of the COPS advice on non-life underwriting risk, where you see how much bigger. Let's just have a look at method 1. A small company had a parameter of 17% for motor liability, a medium company 10%, and a large company 6%. So you can see this massive discrepancy that your large companies, because your books are much more stable, actually need to hold much less capital. And that's something that's not actually reflected correctly in SAM. So this is a good reason not to use SAM for IFRS 17 risk adjustment. So let's talk through some of the bad in SAM. The too much reliance on the standard formula, outdated calibrations, very difficult to do an ORSA with only a standard formula, and what on earth happened to Pillar 3. So let's quickly conclude, and then maybe there'll be a bit of time for discussion. So what have we seen in summary? So SAM is a risk-based framework for insurers in South Africa, which was implemented in 2018. Got 3 pillars: valuation and capital, risk management, and then public reporting. A really good thing SAM did was increase financial discipline and uses the SAM economic balance sheet on which you derive a solvency capital requirement. The way that you do this SCR is you stress your items on the balance sheet. And if you ever want to build a stochastic model, understanding how it was done in SAM is a really good place to start. And we saw the Merz-Wüttrich model as well as principal component analysis for interest rate risk. Some of the issues we've raised is relying on the standard formula or over-reliance on the standard formula and outdated pre-2015 calibrations. And what's meant to counter over-reliance on the standard formula, which is the ORSA, is actually very difficult to do if you don't have some sort of internal capital model. One thing always to be aware of if you're advising boards or management or anyone on SAM is SAM doesn't always capture real world risk well, as we've demonstrated with recent catastrophe losses, which is way beyond 1 in 200 years. And when you think about that, bridging the gap between your small world or your model world and your large world in reality is probably the key challenge. So just a couple of conclusions. We've seen some of the shortcomings, and we've discussed how you could do some enhancements. But despite its imperfections, SAM is still very valuable and much better than anything we've ever had in South Africa, again, in my view. And it's a good starting point for prudent risk management and solvency assessment. So what I'm really trying to say is the good is bigger than the bad and the ugly. And what comes next? So there's a SAM Phase 2 working group under the banner of ASA, run by David Kirk. They're hard at work addressing some of these issues. One thing that I'm quite excited about is a new working group that's going to try recalibrate premium and reserve risk. So anyone who's interested in that, either to contribute company data through ASA, through a CSR-like mechanism, or is just keen to help out a little bit, please get in touch with David Kirk and the SAM Phase 2 working group. Another good thing to evolve SAM for the future could be how can we encourage more internal model use, maybe through a more streamlined approval process, or just building skills in the South African actuarial profession around the sort of capital modeling. It would be amazing if Pillar 3 was implemented, because then we'd have that a lot more information about what's happening in the market, and then thinking about how to supplement SAM with extra risk management tools. So maybe some guidance on stress testing and scenario analysis, or having a set of standardized stress tests for the industry, perhaps with a climate change focus. And there's also currently an ASA working party through the ERM committee, which is going to examine the standard formula validation in the ORSA. So a lot of good things are happening about evolving SAM for the future. And through that, I think the good will become even bigger than the bad and the ugly. And with that, let's stop there and see if there's any comments or questions or points to discuss.
Well, Ron, I think
we
we've got
need
one
at
in
least one, Mohammed.
We've got one in the chat box. Saying, hi Ron, thank you for the session. How would we calculate the capital under type 2 nat cats?
Wow, good question. So type 2 is the simplification in SAM for when you don't have data, and it's generally done with the loss ratio multiplied by your premium. I think a really good starting point would be to know what's the premium level now versus the premium level when those scenarios were put together. That would be almost a first order refinement, and then just recalibrating. So it's not too difficult to isolate in a loss ratio what is your component due to cat, and you can just put a distribution to that. So I think it's a good question, and it's not too difficult to do.
Oh, I see we have a question from Karen.
Thanks, Mohammed, and thank you, Ron. My question is just around the ORSA process, because it seems to be the area where insurers can make up for shortfalls in SAM. Do you think there's enough challenge on ORSAs? I mean, I'm not probing for more tightening of regulation, but I'm just wondering if there's a feedback loop on ORSAs, or should we have ORSAs audited, dare I say so? But like, is there anything more, you know, companies do that for themselves, but I'm just wondering if there's enough challenge to on the outcomes of the ORSA just to make them more rigorous.
Yeah, I think guidance would be really good from a professional perspective, because what does a good ORSA process and a good ORSA outcome actually look like from the perspective of validating the standard formula? And I think if we could answer that question with a bit of rigor, it would really set us up well to then do that challenge, because it's principles based, it's quite hard to know what actually to do, and that's where there's a great role for actuaries to fill in that gap. So I think that's probably my answer, Karen. Even auditing would be tough because you don't have auditing standards for this type of document yet, and building that guidance would contribute to that.
Cool. Thanks, Ron. There's another question from Moses in the chat. Thoughts on misalignment of SAM and IFRS 17? For example, the volume measure is still currently based on IFRS 4. Also, are there any other areas where you think there is a mismatch?
So I think very interesting, the volume measures for premium risk rely on earned premium. And if you look at how you have to calculate your insurance revenue in IFRS 17, you also have an earnings concept. So I actually don't think there's such a big mismatch there. And I think they're just trying to do different things. I think in our short-term world is probably relatively similar, but I think in the life world where you've got a whole new introduction of CSM on your GMM, you've got a very different question to answer, and I think it's very different there. Maybe some of our IFRS 17 experts on the call can tell us what they think.
Means you'll have to be an IFRS 17 and SAM expert to adequately answer.
It's a bit difficult, yeah.
Cool. Are there any other last questions before we close? Doesn't look like it. One more. Updated F202 notes highlight differences between SAM and IFRS 17. Apparently from Talia.
So what we need to do is distribute that to our F203 non-life colleagues, because we won't have seen that, unfortunately. But yeah, that's really interesting. We need to, I think the F203 notes are still pretty out of date.
Cool.
Okay,
Ron,
thank you,
thanks
Mohammed.
very much. I think we all learned a lot. I think you pitched it really well in terms of those who are new to SAM would have learned something from this presentation, and those who are veterans in SAM also would have learned quite a lot. I think I speak for myself when I say, when you download those PDFs for the first time, it's very black and white documents and can seem very overwhelming. And you think these are these technically perfect documents because it's coming from the PA, but I think you've shown in this presentation, due to your insight, you've added a lot of color to those PDFs, and by color I mean green, yellow, and red, but also shown us where some of the gray areas are, and shown us that the FSIs aren't actually perfect in all areas, and we shouldn't take everything for granted, and we still should apply our minds and critically think about, what's being laid out to us in terms of solvency standards, and whether it's appropriate or continuously is appropriate on an ongoing basis. So yeah, thank you for that.
Thanks for the summary, Mohammed. It's great.
Cool. I just want to remind our audience that the recording will be made available to those who registered. A survey will also be shared after the presentation. We would like to employ you to please complete that, as well as we want to encourage you to email actuarialcommittee@ominsure.co.za for any other topics you'd like to see in future masterclasses and industry updates. Please do also be on the lookout for the industry update scheduled for the 24th of April, so later this month, about 3 weeks away. This will be a hybrid event, so I'd be keen to see many of you in person as well later this month, especially those who are writing the upcoming F103 and F203 exams. Cool. With I think that closes us off for the morning and afternoon. Thanks everybody for joining, and we'll see you next time. Bye.
Thanks, Ron. Thanks